Before we dive into the forensic audit, a quick reminder for those tracking the Singapore market. If you want zero-day access to my full forensic reports and the absolute latest on SGX yield plays, you can join Iggy's Elite Investors for just $6 a month via Substack. For those who prefer everything on one platform, the combined YouTube and Substack membership is available for 9 Singapore dollars a month right here on this channel. Free subscribers will continue to receive this content with a 7-day lag. Now let's get into the numbers. The gearing ratio just crossed 49.4%. That single number changes everything about how you should be reading this yield. Everyone is looking at the 8.55% dividend payout, but almost nobody is looking at the 57% net profit contraction sitting underneath it on the balance sheet. Iggy's Elite Investors already have the full forensic breakdown on this one, but today we are going to show everyone exactly why this transition matters for your capital. We are looking at SGX ticker 410, also known as LHN Limited. This is a traditional Singapore space optimizer attempting a high wire act. They are trying to pivot from being a brick and mortar landlord to an asset-light platform manager. Think of it like the MRT door paradox at Raffles Place during rush hour. When those doors start flashing red and the alarm sounds, you have a split-second choice. Do you sprint and risk getting wedged between those heavy doors? Or do you stand back, wait for the next train, and accept being late? LHN is sprinting. By recycling capital and selling off matured properties to fund massive hubs like their new Changi Business Park acquisition, management is signaling they are done being slow. They want to be a high-velocity yield engine. The market usually rewards asset-light companies with much higher valuations, but the transition is notoriously difficult. It requires flawless execution. If they miss a single step, those MRT doors close directly on your dividend payout. Let us walk through the math on this debt wall together. To understand the health of this business, we have to look at the raw facts first. In their latest update for the first quarter of financial year 2026, LHN reported incredibly high occupancies in co-living, but the leverage dynamics are shifting into a much higher gear. Total debt now stands at 347 million Singapore dollars against total assets of 702 million Singapore dollars. That gives us a gearing ratio of 49.4%. For my forensic process, any gearing above 35% is a red flag, so LHN is operating well above our safety ceiling. When we look at the historical context, we see a worrying trend. Net profit has declined from 47 million Singapore dollars in financial year 2024 to just 20 million Singapore dollars in the trailing 12 months. That is a 57% contraction that the headline occupancy figures do not show you. While the dividend yield of 8.55% looks attractive in isolation, a high yield driven by a crashing share price is the forensic definition of a yield trap. The share price has collapsed from a 52-week high of $1.08 down to 59 cents. That 45% compression is the sound of institutional investors disagreeing about what this company is actually worth. Let us move to the first layer of our audit, which is the Coliwoo occupancy fortress. Co-living is no longer a niche experiment for expats. It has become a primary sanctuary for Singapore's professional demographic. The raw fact is that Coliwoo manages 3,200 active rooms and maintains a 96.5% occupancy rate. This performance smashes their 3-year averages and proves they can scale without diluting demand. When we look at peers, traditional residential landlords are fighting just to stay at 90%. Coliwoo is simply outperforming the market. This creates a massive impact on the wallet of a 50-plus Singaporean investor because it provides resilient recurring cash flow. Think of it like the HDB BTO system. The wait times are so long and resale prices are so high that a huge cohort of young professionals is structurally locked out of home ownership. They urgently need high-quality, flexible housing, and Coliwoo is standing right outside the MRT station, handing them the keys. It is a demographic tailwind that is hard to ignore, provided that professional inflows into Singapore remain robust. Then we have the Changi Business Park strategic moat. LHN recently made a surgical strike by committing 101 million Singapore dollars to secure a hotel strata lot with over 250 rooms. This is one of the most aggressive capital moves they have ever made. While most mid-cap peers on the SGX are playing defense and hoarding cash, LHN is going on the offensive. This matters because they are positioning themselves as the primary housing provider for the Terminal 5 construction wave. This is not a standard hotel play. It is a logistics housing strategy with a decade-long tailwind. Changi Business Park is the engine room for the Eastern Corridor. And by planting a flag there, LHN is building a toll bridge. Every contractor working on T5 will need a place for their staff to sleep, and LHN intends to collect that toll. The third pillar of the bull case is their facilities management division. While retail investors obsess over buildings, this division is quietly building a cash flow floor. In the first quarter of financial year 2026, they secured 14 new contracts and renewed 100 more. They now have 10.8 megawatts of installed solar capacity. Free cash flow has recovered strongly to 68 million Singapore dollars. This is pure kopitiam logic. The facilities management division is like your neighborhood minimart. It does not make big headlines, but people buy bread and milk every day regardless of their economy. It prints cash consistently, providing the stability the company needs to take risks elsewhere. But we have to look at the cracks in the foundation, starting with the work plus store occupancy drop. The raw fact is that occupancy fell to 93.1%. Which is a nearly 6 percentage point drop. Management says this is just a technicality, but as forensic auditors, we have to be skeptical. If Singapore's small businesses are feeling the pressure of rising costs, these storage units are the first things they will cut. It is like an established wet market stall. The owner might say they are just rearranging the ice trays, but if you see fewer customers walking away with red plastic bags, the demand is softening. We need to see hard cash receipts, not accounting explanations. The biggest red flag is the collision between their debt wall and that 101 million Singapore dollar Changi commitment. The math here is a hard forensic failure. With gearing at 49.4%, they are way past our 35% limit. Simultaneously, net profit has dropped 57%. In a higher for longer interest rate environment, debt servicing costs will eat the dividend alive. This is like upgrading to an executive condo while your HDB flat is still heavily mortgaged. It looks great on paper, but your monthly cash flow is stretched to the breaking point. This single asset at Changi also pushes them uncomfortably close to my 25% concentration rule, where one building starts to dictate the fate of the entire dividend. Finally, we have the asset-light valuation trap. Investing Pro shows an analyst target of 86 cents, which suggests a 45% upside from the current price of 59 cents. But the math-based fair value models sit at only 61 cents. This massive spread between human narratives and math models is evidence that the market has no consensus on what LHN is worth. Historically, investors love the physical book value of their buildings. Now that those buildings are being sold, the traditional net asset value is shrinking. If the fee income from management contracts does not grow fast enough to replace that lost rent, the stock will stay stuck. This is the classic MRT delay. The lights are on, the aircon is running, but you are not moving forward. Let us step into the wealth check and the yield spread. For this audit, I apply a stress test buffer using a conservative floor of 3.2% as our working risk-free benchmark. While the current spot rate for 6-month T-bills is approximately 1.36%, I test the thesis against this higher than spot hurdle. If the math holds at 3.2%, the margin of safety at current levels is a fortress. We audit for the storm, not just the sunny day. Let us do the math. The dividend yield is 8.55%. If we subtract our 3.2% forensic floor, we get a spread of 530 basis points. On the yield test alone, LHN passes our 150 basis point threshold by a massive margin. But this is where the audit earns its keep. A spread that high on a company with 49.4% gearing and a 57% profit decline is not a reward. It is a warning. The market has crashed this share price specifically because big investors are pricing in these balance sheet risks. The high yield is how the market pays you to take the risk, not proof that the risk is gone. This is the yield trap mechanic in action. An 8.5% yield on a 46% payout ratio sounds sustainable because they are earning more than they pay out. But when that yield is created because the share price halved in a year, You aren't collecting income. You are being paid to hold a falling asset. If you bought at the top, your effective yield was only 4.6%, and your capital is now down 45%. The yield did not save those investors. The forensic evidence shows a clear split. You have dominant occupancy and a great strategic moat at Changi, but you also have a balance sheet that fails our safety standards. For my own portfolio construction, that 49.4% gearing is a non-negotiable watch signal. This is a personal forensic boundary, not a recommendation. A yield that passes the spread test but sits on a failing balance sheet is not a sanctuary. This asset might suit a high-conviction investor who tracks debt covenants every week, but it will frustrate a passive retiree looking for safety. The execution risk is just too high for autopilot capital right now. LHN is one of the most forensically interesting stocks on the SGX mid-cap board right now. This is not because it is a clear margin of safety and not because it is a clear avoid, but because it is genuinely at an inflection point where the next 2 reporting quarters will determine everything. The operational story is real. The Coliwoo occupancy, the Changi Business Park moat, and the facilities management cash flow are not narrative inventions. They are verified numbers that reflect genuine competitive positioning. But the balance sheet is not a rounding error. A 49.4% debt to assets ratio on a company whose net profit has fallen 57% in 12 months is a structural reality that no occupancy figure can paper over. The market already knows this, which is why the share price has been cut in half from its 12-month high. That 8.55% yield is not a gift. It is the market's invoice for the risk you are accepting. For the passive retirement investor managing CPF or SRS capital, this is not your stock. The margin for error is too thin and the monitoring requirement is too active. For the forensic investor who enjoys tracking quarterly debt covenants and operational transitions, this is exactly the kind of setup worth watching closely from the sidelines with a defined watchlist trigger. I am looking for 3 signals: work plus store occupancy above 95%, fee income eclipsing divested rental income, and debt syndication on the Changi commitment. When all 3 confirm in the same earnings report, the thesis changes. Until then, the watch list is the right address for LHN. Make sure you hit subscribe to stay updated on the next forensic deep dive. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.